Nearly 80 years ago, a professor named Benjamin Graham wrote a book titled The Intelligent Investor. It was not a guide to getting rich quickly, nor did it promise secrets to outsmarting everyone else. Instead, it laid out a philosophy for investing that was grounded in business principles, common sense, and most importantly, emotional discipline. Many people today might wonder if a book written in an era of ticker tapes and slide rules could possibly hold any relevance in our modern world of instant information, algorithmic trading, and constant market chatter. The same forces of fear and greed that moved markets then move them now. The core argument of Graham's work is that investing successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What it requires is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. When Graham wrote his book, investors received information slowly through newspapers and annual reports mailed to their homes. Today, we are bombarded with a fire hose of data, opinions, and predictions every second of the day. This constant noise makes the foundational principles Graham taught not less relevant, but in fact, more critical than ever before. Back then, an investor's challenge was often a scarcity of information. The work involved digging through dusty records and doing the painstaking arithmetic to determine a company's underlying worth. The modern investor's challenge is the opposite, an overwhelming abundance of information, much of it trivial or misleading. The temptation is to act on every twitch of the market, every news headline, every analyst's upgrade or downgrade. Graham's teachings provide a filter, a way to distinguish the signal of true business value from the deafening noise of market speculation. His framework is a timeless anchor in a sea of perennial change. This essay will explore the central tenets of the intelligent investor and demonstrate why they are as powerful today as they were in 1949. We will look at the concept of value investing, the margin of safety, and the crucial role of temperament. We will see how these ideas have guided investors through booms and busts, from the post-war economy to the dot-com bubble and beyond. The goal is not to provide a summary of the book, but to distill its most potent wisdom, showing you how these simple, powerful ideas can help you navigate your own financial future with greater confidence and calm. The first and most fundamental idea Graham presents is what we now call value investing. The concept is disarmingly simple. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. He taught that a stock is not just a ticker symbol or an electronic blip on a screen. It is an ownership interest in an actual business. Therefore, your financial success will ultimately be determined by the operating success of the businesses you own. This seems obvious, but it is an observation that is frequently forgotten in the heat of a bull market. Value investing, at its heart, is the discipline of buying stocks for less than their intrinsic value. You must look at a business and ask, what is this company worth as an ongoing enterprise? This involves looking at its earning power, its assets, its debt, and its future prospects. The market price, in the short term, can be a wild and emotional thing. It might swing dramatically based on a news report or a change in sentiment. However, the intrinsic value of a solid business is far more stable. The intelligent investor's job is to take advantage of the moments when the market price falls meaningfully below that intrinsic value. Consider an example from Graham's time. An investor might have analyzed a railroad company, calculating the value of its tracks, land rolling stock, and comparing it to its earnings and debt. If the total stock market capitalization was significantly less than this conservative appraisal of its assets, a purchase was justified. Today, the businesses may be different. Software companies, global consumer brands. An investor can analyze a technology firm's free cash flow, competitive position, growth potential to arrive at an estimate of its intrinsic value. When a market panic causes the stock price to drop 40% without a corresponding drop in the business's long-term prospects, the opportunity appears. The key is to separate the business from its stock. The business is what earns the money. The stock is just a representation of ownership that gets traded back and forth. In the short run, the market acts like a voting machine. tallying up popularity contests based on emotion and speculation. In the long run, however, it acts like a weighing machine, assessing the substance of a business's earnings and assets. The value investor does not try to guess the votes. Instead, he or she focuses on finding businesses of substantial weight and buying them when they are offered for a light price. This is the surest path to a satisfactory outcome. If value investing is the strategy, then the margin of safety is the central concept of risk management that makes it work. Graham insisted you should never pay the full price for a business, no matter how wonderful its prospects seem. The future is always uncertain. Always leave room for error, bad luck, a world that unfolds differently than you predicted. This buffer between the price you pay and the value you get is the margin of safety. The 3 most important words in investing. If analysis says a business is worth $1 per share, don't buy it at 95 cents. That gives very little room for error. A true margin of safety exists when you can buy that dollar of value for 50 cents or for 60 cents. This discount protects you from permanent loss if your analysis was optimistic. When the market recognizes true value, the price will rise to meet it, delivering a handsome return. This principle applies beyond stocks. It's engineering and everyday life. Engineers design bridges to handle the maximum load, then build them to withstand 3 times that load or 4 times that load. That's the margin of safety. You don't build a bridge to hold exactly 1 truck, you build it to hold a line of trucks even in a hurricane. The intelligent investor must apply the same conservative logic to their portfolio. Today, the margin of safety is often ignored. Investors chase momentum buying stocks that already went up, hoping they go up further. They pay exorbitant prices for companies with exciting stories, no current earnings, and heroic assumptions about the distant future. This is the opposite of Graham's approach. The intelligent investor buys on pessimism, not optimism. They look for good businesses that are temporarily unpopular or overlooked. Graham knew that even with a sound analytical framework, investors were their own worst enemies. He introduced a brilliant allegory, the parable of Mr. Market. Imagine you are partners in a private business with a man named Mr. Market. Every day he shows up and offers to buy your share or sell you his. He is a manic depressive. Some days he is euphoric and quotes a ridiculously high price. Other days he is despondent and offers his share at a foolishly low price. You are under no obligation to trade. You can ignore his daily offers and focus on your business's operating results. If he shows up panicked and offers a price far below what you know the business is worth, you can buy him out at a bargain. If he arrives full of irrational exuberance and offers a silly price for your stake, you can sell. Most people let Mr. Market's mood dictate theirs. They feel euphoric when he is happy and panicked when he is sad. This story shows the correct attitude toward market swings. The market is there to serve you, not to instruct you. Its daily quotes are not a judgment of true value. They are just offers from an emotional partner. You are not required to act. That's a major advantage for the individual investor over many professionals who are judged on short-term performance and feel pressured to trade constantly. You can sit and wait for the truly great pitch. Adopt this mindset, and you stop seeing falling markets as disasters and start seeing them as opportunities. When prices decline, Mr. Market gets more depressed and the bargains get better. Conversely, when the market soars and everyone celebrates, the intelligent investor gets cautious, knowing high-priced offers are untrustworthy. Think like a business owner. Focus on the long-term health of your companies. Focus on their profitability. Use Mr. Market's mood swings to your advantage. Ultimately, Graham's most enduring lesson is that success in investing is not a matter of intellect, but of temperament. A person with a 160 IQ can easily go broke in the market if they are unable to master their emotions. Conversely, a person of average intelligence who can remain calm, patient, and disciplined can achieve wonderful results over a lifetime. The daily gyrations of the market are a test of character. They are designed to provoke 2 powerful emotions: fear, when prices are falling, greed, when prices are rising. Giving in to either is a recipe for poor returns. Fear is perhaps the more destructive. When markets are in free fall and headlines scream about a crisis, the instinct is to sell everything and run. That often means selling excellent businesses at the worst possible moment, locking in losses and missing the recovery. The intelligent investor combats this by having a plan and sticking to it. They have already determined what their businesses are worth and have bought them with a margin of safety. A drop in price does not change the underlying value. It makes the business a better bargain. Being greedy when others are fearful is the path to wealth. On the other side of the coin is greed. During a roaring bull market, it's easy to get swept up in excitement. Friends brag about easy money, and you feel foolish sitting on the sidelines. The fear of missing out can lead you to abandon your discipline. You might start buying stocks with no margin of safety, convincing yourself this time is different. But it is never different. Trees don't grow to the sky. Bull markets don't last forever. Being fearful when others are greedy preserves capital. Graham stressed simple rules and automated processes. For most, that means a regular automatic investment into a low-cost index fund, regardless of the market. It enforces discipline and removes the temptation to time the market. For others, it means a strict checklist for buying a stock, no deviations. Build a fortress around your decision-making to withstand Mr. Market's emotional assaults. Your long-term financial well-being depends far more on behavior than brilliance. The Intelligent Investor is not a book about beating the market. It is a book about how to behave in the market. Its lessons have endured for the better part of a century, not because they offer a secret formula, but because they are based on the unchanging realities of business and human psychology. The world of finance will continue to get more complex, with new products, new technologies, new theories, but the fundamental game will remain the same. Businesses will produce profits, and human beings will react to market movements with fear and greed. Graham's wisdom provides a timeless operating manual for navigating this environment. The core principles are remarkably few and wonderfully simple. First, think of a stock as a piece of a business, and never forget to analyze the business itself. Second, always buy with a margin of safety, protecting yourself from bad luck and your own errors in judgment. Third, view the market as your servant, Mr. Market, whose emotional offers can be taken advantage of or ignored completely. And fourth, recognize that your own temperament, your ability to remain rational and disciplined, is your most important asset. These pillars form a complete philosophy for a lifetime of successful investing. You do not need to be an expert to put these ideas into practice. You can start by investing in a broad, low-cost index fund, which allows you to own a piece of many great businesses without having to analyze them individually. You can commit to investing a set amount of money every month, thereby buying more shares when prices are low and fewer when they are high. This simple approach embodies Graham's principles of ownership, patience, and emotional control. It is a straightforward path that, followed consistently, is almost certain to produce a satisfactory result. In the end, the secret to intelligent investing is to get the big decisions right and to avoid serious mistakes. It is about developing a sound business-like approach, arming yourself with the defense of a margin of safety, and refusing to let the emotional whims of the crowd dictate your financial future. The world has changed, but the rules for sound investing have not. By internalizing these few simple ideas from Ben Graham, you can build a framework that will serve you well for the rest of your life. Your first step is simple. Make a plan grounded in these principles, and then have the discipline to follow it. Why the intelligent investor still matters today. If this breakdown of the intelligent investor helped you think about money in a smart way, subscribe to Outlaw Wisdom for more videos on investing, financial disciples, and timeless wealth building principles.